I'm Seth Goldman. I'm the president and CEO of Honest Tea. We're based in Bethesda, Maryland. I started Honest Tea out of my house in 1998 and started with 5 thermoses and an empty Snapple bottle. And we're still based in Bethesda. Last year we did $23 million in sales. And in January of this year, we closed the investment with Coca-Cola, where they purchased 40% of our company. Coke purchased 40% of the company, and they have there's a formula for them to purchase the subsequent 60% of the company 3 years from now. And that formula is based on a multiple of sales for what our sales will be 3 years from now. So the overall acquisition price by the time the deal closes, if you go off the $23 million, could easily be 10 times sales by the time the deal closes. The mission of Honest Tea is to sell healthier organic products and beverages, at least for now. So our products have at least half the calories of all the prevailing offerings on the market. Everything we make is USDA certified organic, and a significant portion of our products are also fair trade certified. And both Coca-Cola and Honest Tea are committed to maintaining that aspect, that everything we sell is authentic, healthier, and organic. We also have won awards for employer-friendly policies. We support a local sustainability initiative in Bethesda, our home market. We have a whole bunch of partnerships with bicycle companies, with the Ford Escape Hybrid. So, the way we build our brand is through partnerships with different nonprofit organizations, and so we'll certainly continue to build those relationships over the years. We've been growing the business for the past 10 years, and with great success and speed. We grew 70% last year. So someone might say, well, why would you sell? But for us, we saw so much more opportunity before us, and in terms of consumer demand, but we saw a lot of barriers around distribution, that we were not able to reach all the consumers who want our product. And we weren't able to produce the product to reach those consumers. So those two key things, production and distribution, were, I don't want to say insurmountable barriers, but it would have taken at least another 10 years to find a way to reach those consumers. And the marketplace changes quickly. There was no guarantee we'd be able to succeed and capitalize on the opportunity. And nothing's a sure thing, but working with the world's largest beverage company certainly enhances the odds that Honest will be the brand to realize that opportunity. The deal we struck with Coca-Cola was very unusual, and it was really it was unusual for Honest Tea. We'd never done it before, but it was also unusual for Coca-Cola. They created a new division called the Venturing and Emerging Brands Division, and it was based on a recognition that the way they were trying to build brands before was failing. And so rather than Coke saying, we're doing it our way, they went in with a great deal of humility and said, we want this brand, the Honest brand, to be big. We don't know exactly how to do that, so we need to retain the management team that's built it for the past 10 years. We will give you governing control of the company. We'll incentivize you to grow it. And so the way this works is they have 40% of the company, and we have majority control for the next 3 years. They have the ability to buy the company 3 years from now, and from there, we'll see where things go. In terms of the specifics of the deal, Coke bought 40% of the company in January of this year. They have the option to buy the remaining 60% of the company 3 years from now, and it's going to be a multiple of sales. It'll be roughly 3 times the first $100 million in sales, and then a little bit less on sales above that level. For the next 3 years, we still have majority control in terms of the board and governance and the way we run the business. There was no written contract ensuring that everything we'd sell would be organic, but Coke invested in the company because we've created real value in an organic brand. So they have really zero. First of all, for the next 3 years, we have governing control, so it's up to us whether or not it stays organic for the next 3 years, and there's no reason we would switch. Our intent is to build such strong value for the brand and for its attributes that they would have no incentive to switch out thereafter. And it was interesting. The folks at Coke made a comment. They said, "We've learned from the new Coke experience. When they brought out a product, they tried to change, reinvent something, and got pummeled for it." So This is a company that has some awareness of the danger of tampering with something that's working. We've had, over the past 10 years, a lot of different companies have approached us with an interest in buying us or investing in us, and we never had really gotten to a comfort level with where we felt it made sense for us to move forward. What was appealing about the Coke opportunity was they said, "We love what you're doing, we want you to do more of it." And we're on the same wavelength. We want to do more of it too. And so the fact that they give us the control to run the company for the next 3 years as we see fit is perfect, from our perspective, a perfect way to really build the brand out and to build it with the same attributes it's had where we've created the value. I had no interest in running a company that's not the same company I've created. So the team we have is the team that's built the brand, and I expect as we grow we'll add new people, and I'm sure some people won't be able to keep pace with our growth, but it's up to me and the board we have is the same. It's my co-founder Barry and Gary Hirschberg, who's been on our board for a long time, have the majority. There are 2 people from Coca-Cola who obviously it's important that we have them on so we can really know how to make the most of Coke's business, but they don't have the majority of the board seats. Whether this was done right, we'll have a better sense in 3 years or maybe 10 years. But we learned a lot from Stonyfield and what they did, and I think that is certainly right now, I would say Stonyfield did it right. Gary is still running the business. He's still doing it with all the passion and fire that he had for the previous 20 years. And I'd like to think we've modeled a lot of what he's done. In fact, he's even said, we've one-upped it in terms of, getting a few of the details right. I think one area which we might have done a little better is finding a way. I'm definitely running the company for the next 3 years. Then the question is, what happens after that? Well, the way it's all organized right now, Coke has total 100% ownership. Gary still retains a small, portion of ownership of Stonyfield Farm. And the way entrepreneurs work, if I were to be around after 3 years, I would want to feel like I still had a measure of ownership as well. And it's not something I've raised with Coke, but that may have been an interesting, and it's certainly conceivable that I do know they want me to stick around for as long as I want. So I would assume that if I'm going to stick around, that would be a precondition. It was wanting to retain some feeling of continued ownership. I think my goal, as it's always been, is to demonstrate that we're building something of value and I'm a key part of it. They certainly recognize that, and my viewpoint is that if 3 years from now I'm having a great time, I still want to be there, then it's because we'll have been successful and they'll want me there. So I'm not worried about that right now. Well, one of the reasons I haven't been as worried about specific covenants in our agreement is because I know what our brand stands for, and I know where the value is, and it's an authentic, organic, and healthier product. If I had a brand, where I was giving money away on the profits, I'd be worried because there's no guarantee a big company is going to continue to do that. I joke Honest Tea gives away all its profits to charity. We don't have any profits, so it's easy to. But every time we sell a bottle, we're doing something powerful. We're helping communities develop more sustainable commerce with organic and fair trade, production. We're doing something for consumers by offering them healthier products, and then our partnerships as well. It's much, for me, our value and the mission is in the bottle itself. And I don't see a Coke investing in the brand and then stripping out those components. So I think it's important for an entrepreneur to know where the value is in the company. Build the value build the value of the company around the values that are important to you. And if those are intrinsic to your brand and to your product, I don't want to say don't worry, but I think you got a much better assurance that even under a larger umbrella or a larger organization, those components will be retained. It's funny. I was very conscious when we were closing the deal. I was monitoring myself, looking for, was my hand shaking when I signed the transaction? Was I losing sleep? And I lose sleep anyway about the business. I was up at 4 this morning, just because I'm, like a lot of entrepreneurs, you get pumped up and passionate about it. But I didn't have that, sort of wrenching feeling in my stomach. I felt very comfortable with this transaction. I felt like this is the right time, this is the right opportunity, this is the right partner to build what we've started. So, 3 years from now, I may be kicking myself and saying I did it differently, but this feels like the right move for us right now. We walked away from other deals earlier. We had other opportunities that were similar but didn't have all the right components, and so when this deal came, we really knew this was the one that made sense. We had other companies that wanted to buy the whole thing, or wanted to accelerate the timetable or not retain the management team, and those were deals that we just didn't take an interest in. The way we took our investment in over the 10 years leading up to it was very important in terms of giving us control when we did the deal with Coke. I've seen lots of entrepreneurs raise money, more money than they needed, and as a result, when they got into a tight situation, they were forced to sell in a way that was not one they controlled, not under their control. And so as we grew, and I know Stonyfield and Gary would say the same, only take in as much money as you need to run the business. Number one, it creates a good discipline. You make sure you use your resources well, but it also means you're giving up less control in the early years. Where for the discussion in Aspen is, where does capital come from for these entrepreneurs? How do they get it? And so it's not just how they get it's not where they get it, but how they take it in. What is the structure they create for the company? And so certainly one suggestion is be very disciplined about the capital you raise. I've heard venture capitalists say no one's ever complained about they raised too much money. And I say, well, they may not be around to complain about it, because a lot of entrepreneurs get bounced when they take in too much money. They get pressure to use the money aggressively, spend it on marketing, and they turn around in a few years, where'd the money go? And then the venture capitalist says, well, that's enough of that entrepreneur. Let's bring in a professional, pump this thing, and dump it off to somebody. And I'm very glad to say we didn't get ourselves in that position, because we were very conservative about how we raised our money. And it was that means a lot more work. It means a lot. I spent a lot more time raising money from angel investors, and that was a challenge to do. But at the end, we're at a place where we can say we've done a great job for our investors. Our investors who started with us have made more than 20 times their money, and they still have a 60% residual interest in the company. And we've built the brand our way, and we found a transaction and a partner who still respects what we're trying to do. The world of socially responsible investors is not sufficient to build a brand. So while we certainly had investors who came to us because of what we're doing and they supported that, the world of Investor Circle and that kind of thing was not enough for us to capitalize our business. You have to have a business that stands on its own merits. You're not going to be able to raise, at least we weren't able to raise money just from people who wanted to help save the world. It's got to be a strong financial proposition, and I'm glad to say ours was. But I will say I guess it's a false hope to think you're going to raise all your money from socially responsible investors. There just isn't enough capital out there from that group, in my opinion. In business school, I always idolized the venture capitalists. I thought those were the people who, I thought that's what I wanted to be. And now that I'm an entrepreneur, I have to admit I've lost a little bit of appreciation for the role the venture capitalist plays, because they try to, get you hooked on using a lot of money. It's a self-serving addiction. If an investor gets an entrepreneur to get, hooked on spending a lot of money, then then he's going to need more money, and the VC ends up owning more of the company. And so I'm glad to say that we've been able to build this without the involvement of professional VCs. I got a lot of things out of going to Yale. I mean, my co-founder was my professor at Yale, but it was funny because when I was at Yale, there were no classes on entrepreneurship. There were no classes on venture capital, but there were obviously some good classes on just core management skills. And I think a lot of what I've had to do has been beyond the MBA. So what Yale gave me was actually the best thing Yale gave me was the conviction that you can run a business with your values. And in a lot of ways, I got that from Yale. I also got it from Net Impact, the MBA network of, for socially responsible business. And those were the things that I think really helped get me on my way.
I found it really interesting to see how different the businesses were in terms of where their mission showed up in the value chain. Because in the first business, the mission was clearly in their supply chain, was what was important to them, and so the implications of how a transaction unfolds there are very different than. And I love the way he said, our mission's in our bottle, and so in a business like that, if Coke sells 1 billion bottles, every bottle really does help the mission, and so it seemed to actually be a really great fit. What happens at the 3-year mark? Who knows? I do find myself concerned about valuation and valuation expectations as I listen to some of these deals that get done, and think about, from an economic perspective, what's an economically sustainable price to pay for a business, even with an enormous distribution network. And I think about, could Coke pay what they pay now? Yes. At 3 times, or maybe what's an average of 2.5 times sales in 3 years, I start to think about how much of this stuff would Coke have to sell over what period of time, with what gross margin, to actually make an economic case for this deal. And so this is more my question to maybe somebody in the room who has spent more time in a consumer business that could help me understand how did Coke make that work? Because I just flat out don't get it.
Okay. Does anybody know the answer to that question or have an idea? Ron, I'm thinking you might have some thoughts on that.
I think one thing to add to that context maybe is a bit of desperation. Coke looks at Pepsi and sees what Pepsi has done with its portfolio, and Coke is feeling tremendous pressure to show something to the marketplace. So in terms of negotiations, they may have had some leverage, may have been on the other side. Coke felt it had to show the market something. That's one thing. But I'm a little worried when I hear that, especially when I hear that after 3 years, it's all up to what Coke wants to do at that stage. I would be worried under those circumstances.
The thing I could add to this, because of my conversations with Seth about this, Seth kind of represented it almost as if, and he seemed to say it somewhat in the video, that Coke kind of came to him with their hat in their hand. And they were basically saying, listen, we've discovered that we can't create these kinds of businesses. We don't have the credibility to do it. And we can't run them. And so we need to acquire you, but we need to have you run it. And what I think Seth's assuming is that after the 3 years, they're going to probably want him to continue to run it if he wants to. If he continues to be successful, which I suspect he probably will be, especially with all of Coke's help, the possibility is good that he could cut a deal then. Why he didn't have that be part of the deal at this point, I don't know. But it's a very interesting question.
I do share the concern that some of the people have shared about the 3-year period. And what I heard Seth say, that he was optimistic that if Coke understood the value of the business and the mission of the business and appreciated the uniqueness of that, well, then the equity, the mission would stay intact over time. Now, I've been through this 3 times now with multinationals, with different companies. I've been through it with Kraft. I've been through it with the Hanes Celestial acquisition of Celestial Seasonings. I've been through it with the Unilever acquisition of Ben & Jerry's. And what I will say is a couple of observations I've seen. Is first of all, what I've seen is large corporations in general assume that over time they can learn what the companies they've acquired know, and that they can put that to work, and that no one's indispensable. So that's one thing. The second thing is there is a natural, and it's not a malicious gravitational pull within large companies towards homogeneity. The larger a business gets, and once you're running a 50 or $100 billion business or more, you know, these businesses are very complex. The systems within the business, the people within the business will attempt to smooth off the rough edges because rough edges create complexity. That means there's a natural tendency, it's not malicious, it's built into the DNA towards homogeneity, unless you have it built into your acquisition agreement. So that's the second piece. The third piece that I was concerned about that I heard Seth say at one point was, he said, well, at the end of the day, you know, our bottom line is we do a lot of good in the world. We do a lot of good for our employees. We do a lot of good for our... There's a point in time, I have yet to see a multinational that has said, well, good, just keep doing that and we'll be happy. I think what Gary said was very true, which is at the end of the day, they want it all. They want growth, they want profitability, and they want social values. And I would argue you can't be truly a model for social responsibility that other businesses want to emulate unless you can deliver all three. So I loved what Seth had to say. I hope that all his optimism is well placed, and I'm also a little bit concerned based on my past experience, and I only hope that Coke lives up to Seth's expectations.
Given your experience, would you say in 15 to 20 years that all the things that he does with his employees and with the nonprofits, et cetera, would be still present and operative?
Based on my past experience, I would say it's very unlikely. Being the eternal optimist, I would say nothing's impossible. Seth's a smart gentleman, but I would say past precedent would say it's very unlikely.
Anyone else? Yeah, Pierre?
I worked for Coke for 20 years, so let me give you a little insight on the valuation. One of the points that that Ron made was that they needed to show the street, Wall Street, the performance for the U.S., for North America, was actually a reversal from the decline they've been declaring. And the purchase of vitamin water, Glasso, Honesty, Fuse, and one other brand, but I forget which one it is. But there are 4 brands which they've bought, and they've consolidated into that one company that Seth talked about, which is not about Honesty, it's about the emerging brands. And I'm sure he knows, but there's already a Coca-Cola executive in charge of all of it, whom I know, who's going to have an interesting relationship with Seth. But the economics are, Honesty did $23 million with probably around 4,000 or 5,000 outlets. And Coke has 2 million vendors in the United States alone, probably 5 million vendors worldwide. And then you add just the retail outlets, probably in the United States, 1 million outlets, just physical places like 7-Eleven. It doesn't take much to see how the sales rate could grow. What's interesting about the deal is that their Coke is taking on the distribution and will grow. You know, how are they going to control the growth so they don't pay too much during the 3-year period? That's going to be interesting tension, because obviously Seth wants to grow it as fast as possible because he's going to grow, what, 3 times at 100 million, and then so I don't know how they're going to manage that. But Coke has thought that through, I'm sure, already.
So as a clarifying question, I want to understand, I hear that it's distribution leverage that lets them pay that large of a multiple of sales. But then the question becomes, if they're a partner now and they're helping the business grow now and will do that for 3 years, it seems like they may have some real challenges in, over the long term, actually making this a profitable acquisition if they let it grow too fast.
You know, we'd have to run the numbers. We'd have to run the model and set it up. But I think there's other things going to happen. Seth is probably paying around 17 cents a bottle. Coke probably pays half of that. So there's going to be some immediate margin improvement. Now, whether or not they're going to give him that right away, or the price is basically set on sales alone, so the margins can grow, and then, you know, because they got 40%. I don't know how that arrangement is, but the cost of goods will go down dramatically. The cost of labels will go down, and I mean, it's just a dramatic impact. And actually, we saw that at Ben & Jerry's. I mean, the moment you guys came in, you bought all the supplies at half the price we were paying, and the EBITDA doubled, practically doubled, just like that, just out of sheer purchasing power. Now, I think that the Honest Tea deal is actually easily justifiable. I think it's from a financial point of view. The one that's really complicated, I think, from a financial point of view, and I try to run the numbers, was Glasso. They paid 10 times sales. The company was doing $450 million, and they paid $4.5 billion. And, you know, that is hard to justify. That was hard to do. And I think it's got to be international sales of some sort. Plus, that's the other thing, because at the end of the day, Honest Tea will be available probably in, you know, something like 5 million outlets at some point. And those are the numbers.
When Seth had the idea for this company, he came over to Wayne's house in Washington, D.C., and he brought a thermos and the Snapple bottle that he talked about. And we sat in the kitchen, because Seth was working for us at Calvert when he broke away to go do this. And so he poured out this tea out of this thermos, and it was the jasmine tea. And Wayne and I both tasted it, and we were real positive, you know, oh, you know, it tastes pretty good, you know. But I still remember when he left, and Wayne and I looked at each other after the door was closed, we both went, because we just thought there's so little taste to it, because it did not have, it had very little sugar. But we also thought, could be interesting. Well, were we wrong? Does anybody else want to throw anything in? Don.
So aside from the mechanics of the deal, I'm interested in the trickiness of authenticity, specifically not with Honest Tea, but I heard an NPR ad the other day by Tom and his wife from Tom's of Maine that was clearly portraying the company as a family business. I can't remember the exact verbiage, but there's no question that the image they were creating was one of a small town family business. And it is clearly no longer, obviously there was no mention of Colgate, but beyond that, well, I just have a lot of questions about authenticity in these brands when it changes hands, or a majority changes hands, and how the brand is portrayed, and how people feel about that.
It does seem pretty clear that it would be hard to dilute, are you organic or not organic? And it'd be hard to dilute, are you fair trade or are you not fair trade? And so those are the two things he's trying to sustain. I can see why he didn't feel he needed to put together the contract that Gary put together, because they do believe it's baked into the bottle. As those of us who are on the board of Unilever know, there's all kinds of ways things can start to get diluted by people who don't understand your brand and your social mission. And we have learned that we have to be continuously watchful, because things happen when people think they're just doing their jobs that affect what is the values that we have baked into our brand. But these two values that he's got baked in his brand, it seems like they would be hard to dilute. So I can understand from that point of view the wisdom of his choice. Is there anyone else?